In this video, we are going to look at the Evansville, Indiana MSA. And if you look on our map here, you can see we have Indianapolis up here to the northeast of Evansville. We've got Louisville, Kentucky to the east, and we have St. Louis to the west right along I-64. Okay, so it gives you an idea where in Indiana this is located. So a little bit in the southern part of the state. So what does Evansville, Indiana look like? This is one of the smaller MSAs that we've done. You can see there's only 310 properties here. So if we look at our filters, we can see that we have excluded all corporate, all military, all senior, all vacation, and we're only looking at market and market affordable. And you'll see that if I uncheck market affordable, we only lose 14 properties. So that's why we go ahead and check that versus adding the affordability component to it, which would be a much bigger piece of the pie. So we were just looking at conventional apartments. A few of them do have an affordable component to them. All right, so if we go to our analytics to take a look at this, we can see that there are 16,534 units for the 310 properties. There are none currently under construction, and you'll find that they just delivered 180 units to the market. Negative 26 last 12 months. 26 people have left. More people have left than have come to the market, according to this. Vacancy is increasing, which would be indicative of the 26 people exiting stage left. Though we are still showing a rental increase year over year. And then, of course, on the capital market side, we have our sale price per unit increasing about $9,000 a door, and cap rate going down about 2%. But I think this is all going to change soon. So let's look at the data and see what it's telling us. So we can see, again, we look at effective rent because asking rent is what the property manager is asking. Effective rent is what they're actually receiving. So we can see that in first quarter of 2022, it was $823, went up to $846, up to $851, up to $852. So interestingly enough, it has slightly increased, though plateauing. We do not look at 23 Q1 because there is not enough data here. This is erroneous information. And the fact that CoStar is about a 6-week delay means this is fourth quarter data anyway, or they're anticipating what this is going to be. So we're not going to look at this information. So we're going to stop right here. So we have steadily increased to 852, but is slowing dramatically. Let's take a look at our deliveries and absorption. So 180 units delivered in first quarter, only 58 absorbed, and then of those 58, 98 left the market. So you're really negative 40 from when that 180 delivered. Then 81 absorbed, so now we're at 41 absorbed since they delivered this 180 units, but then another 59 left. So now we're negative 19 since they delivered these 180 units. Now, we don't know whether it's directly correlated or not. We'll see when it goes to A, B, and C. And were these delivered in the A market or were they delivered in the B market? And we'll take a look at that here in just a second. But you can see how it's affecting occupancy. So occupancy went down, obviously, because we went negative 98. But because this is such a small mark, only 310 properties, 81 units affects that. So if we absorb 81 units, that vacancy or occupancy ticked up. Then as we leave the market again, it starts to tick back down. So we're teetering right on that 95% mark right now for the occupancy. So I think if this trend continues where they're not absorbing and people are leaving probably because the rents are getting too high, even though these rents are under $1,000 on an average basis, this could end up being what's known as a fracture in the rental market, and we could start to see a downtrend. But let's see what it looks like for each asset class. Let's look at the A's first. All right, so here are your Class A properties. And again, we're just looking at effective rent. So we have 1,122. At the end of the year, we started at 1,179. So the A's definitely are being affected by these deliveries, which tells me that the deliveries more than likely are going to be in the A market. So we started at 1179, went up to 1220, down to 1188, and then down to 1122. So this market is actually seeing a year-over-year decline, and this is only the second market we've seen that happen in the A space. All right, so let's see why. If we come over here, all right, no deliveries. So that's just people leaving the Class A market. So those are very small numbers. So we can see that we only have a total of 1,258 A's in the market, and we've got people leaving. So 8 more people left than what came into the market, but it really affected the occupancy here, which also affected those rents. So even though we're not seeing any absorption, we're actually seeing negative absorption, it's really negatively affecting these rents, where we didn't see that in the overall rents when we were looking at A, B, and C. So let's go look at the Bs and see how this is affecting the Bs. But we can definitely see this downward trend, albeit that very, very slight tick up right here because of the 2 units that absorbed here. So let's go see what the Bs look like. All right, so here are our Class B rents. Again, effective rent. We started at 827, went to 850, 860, 871. So we're showing still a strong rent trend growing in the B market. That's very interesting, because if we come across, there's our 180 that delivered, and it seems to have absorbed most of that 180 units. So 46, 60, 70, 137 of the 180 absorbed, but then 30 left. And the fact that we didn't see a downturn in the rents means that in the next quarter, we are probably going to see some negative rent growth because of this 30 that left. Okay, so let's just keep an eye on that. So interestingly enough, because these units absorbed, we continued to maintain rent growth. My guess is starting next quarter, we are definitely going to start seeing some negative rent growth, especially with 30 of the 130, 137 that have left. So that means you have 107 of 180 that have absorbed for the full year. Now let's go look at the C's. So here's our Class C market in Evansville, Indiana. Here are our effective rents. So we started the year at 741 of 2022, went to 760, 767, 769. So A's and B's continued an upward trend all year long, where the A's started trending down in the second quarter. So big difference between the A's and the B's and C's, which tells me there's an affordability issue in this market where it comes to the A's. So let's come across. We definitely should not have any deliveries or under construction. And we've got quite a bit of an exodus here, which does not indicate a correlation to those rents. So it's interesting that those rents are still climbing, because we have here 141 left and only 25 came in. So 116 negative absorption in the Class C, yet we're still showing increase in rent trends, even though the occupancy is decreasing. So we're definitely seeing a fracture in the Class C market. We saw a fracture in the Class B market and negative rents already occurring in Class A's. So pay attention to Evansville, Indiana, because it is definitely showing that downward trend. So this concludes today's market for Evansville, Indiana. Tomorrow, we'll be looking at Atlanta, Georgia. I will talk to you guys tomorrow.